and this is the last session of this conference. And thank you for keeping patience and waiting for us to give you insights into innovation in alternates and what to look out for in terms of strategies in the year 2020. Just a brief introduction for myself and our panelists. My name is Jai, and I represent One Tree Hill Wealth Partners. We have Samit here, who is the co-founder at SageOne. And anyone who's been some sort of involved with mid-caps, small-caps, micro-caps has to know Samit, else, you guys have been missing out on a lot of investment advice. There's Amit from 2.2 Capital, who is the founder at 2.2 Capital. And at least from what I have seen, they're one of the fastest growing PMSs currently in the country and have given fantastic returns. To start off briefly and give a flavor as to what we are trying to do in this panel is to try and cover as many topics in the time that we have, and then obviously try and provide insights into what we see in 2020. So if I can start off with you, Samit, where do you see, and one of the sort of the innovations that has happened recently has been the long short funds, right? Where do you see this taking place from a next 3-4 year perspective? Who are the players that you see? What is the AUM that you think that will get garnered? And is there a good amount of alternatives in this segment compared to the products which are currently there?
Right. So I think what's happened over a period of time, especially in India, is that there are a lot of families, a lot of industry groups which have accumulated a lot of wealth. For them, I think the primary focus is how do you protect that wealth, and at the same time grow it at a rate which is much higher than the inflation, right? So with that, they're looking for products which are less volatile. They don't want to see big drawdowns in their wealth, and that's where long short definitely plays a big part. So there is, when I meet investors, especially the large family offices and also the global funds, the demand for long short is very high. Sure. Unfortunately, we haven't. There are a lot of limitations to manage a long short fund in India, given that you can only short the stocks which are in the FNO, sure, right, which are less than 200, I guess, and it's very difficult to create the right hedge, because you might be buying maybe the stocks that you like are in the smaller market cap, and the only thing which you can short are these large caps. So I think because of that mismatch, it's been difficult. But I think over a period of time, I think even the regulator would realize, and they will expand the the list of FNO stocks, and hopefully we will have much larger universe in which we can manage a long short fund. But I think the potential is huge, and especially from a foreign perspective where the cost of capital is so low. Correct. You can get a lot of leverage capital into this, especially if you can reduce the volatility, and I think it has great future.
Okay. And for someone like you coming from a fundamentally sort of long only background, would you also look at some point to get into this space?
I think yes, because see, if you are a good identifier of stocks, the exact corollary to that is that you should be able to identify the bad stocks, right? So India has so many listed stocks. Even if you consider 500 as your universe, if I'm able to find 20 good stocks, it should not be difficult to find 20 bad stocks, and it helps reduce a lot of volatility. And especially from a foreign investor perspective, whenever the Indian equity markets go down, even the currency tend to go down along with it. So there is a double whammy. With long short and with a hedged product, I think you can reduce that kind of volatility and attract a lot of global capital. So definitely it's something which is in our radar when it becomes more practical to manage that.
Understood. And Amit, as Samit was saying that if you can try and capture the good stocks, it should be easy to capture the bad stocks. And obviously, I think some of the articles that you've written in the past year or so does exactly that. Do you share the same view as Amit with respect to sort of long-short funds?
Yeah, no, I broadly agree. So investing when you're doing the work on trying to find good ideas, trying to short is pretty much exactly the opposite of that.
Right.
If you're looking on the investment side, good companies, good growth outlooks, valuations which are reasonable. On the short side, you're looking for the exactly opposite. But unfortunately, things are not that easy, because right now the industry, long-short fund industry, because it's so nascent, there is a very small part of the market which actually focuses on the short side. So what happens is that there tends to be a bias towards the positive side, which is why even if you are convinced that a company is absolutely going to go down, or stock is going to tank 50%, 60%, it might happen after it first goes up 4x.
Sure.
And because there is not enough ecosystem which would apply the reverse pressure, there isn't enough sell side research which covers ideas from the short point of view because they're not incentivized well enough.
Right.
So a sell side research analyst, if he writes a short report, he can only go and talk to people who own that stock. Right. But if he's writing a buy report, he can go out and talk to pretty much anyone in the market. So because that ecosystem does not exist, as of now, the long-short fund universe will go through a very tough phase. But as a product, I think there is a lot of potential for it. It's going to keep growing over a period of time. And in fact, till last year, we had been seeing the long-short fund AUMs continuously going. Many of the funds were doing phenomenally well. Evenders, Edelweiss, many of these strategies who had launched long-short strategies several years back had started to mature and people had started to accept those strategies. But what has happened over the last 1 year is, there have been certain changes on the tax and regulatory side, which makes a long-short strategy pretty much unviable. What has first happened is on the taxation front, which is, the surcharge that has come in.
Right.
So for example, if you're running a Cat 3 AIF, you have to effectively pay a 43% tax on derivative income, which is how a long-short fund would work. Now, even if you're a good fund manager, it is very difficult to deliver post-tax alpha if your tax rate is as high as 43%. So that has been one major hit for long-short strategies. Second, and this is, Samit had alluded to it, the universe of companies that you can short is actually quite small. It was 210 a year and a half back. As of now, it is only around 160, 165. That number is actually shrinking.
Sure.
So instead of, we thought that this number will keep increasing as, the liquidity increases in the market. People will find more avenues to short companies. The reverse is happening. So again, as a long-short fund manager, you are operating in a market where you have lesser universe of stocks to pick from. That makes the ability of a fund manager to generate returns difficult.
Sure.
I think it will change over the longer term, but whether it will happen over the next 1 year, 2 years, it's difficult to say. But over the long term, we do need a shorting ecosystem in India.
Fair enough. Thanks, Amit. And that's probably one of the reasons that we've seen only 3-4 relevant players currently who scaled up to a level where, you can say that this is our philosophy, this is our process, and this is what we are selling, rather than saying that we start off with a process and keep iterating that over time. The other point that I think, and I just want to touch upon this since both of you all are also PMS managers, is with the regulatory changes that SEBI is taking place, and obviously this is relevant for different strategies for innovation. While we are talking about PMSs, where do you see regulation taking place and what part will SEBI play in terms of keeping up with different innovations or different products or different services, especially on the alternate side?
Yeah. So I think, last 2-3 years, SEBI has been kind of an overdrive in terms of coming up with regulations for all market participants. We had seen first the regulations that came out for the mutual funds in terms of categorization of funds, limiting the number of schemes that each fund house could offer. Then we have seen the PMS regulations which came out later last year. And now we are hearing about the draft guidelines on the advisory or RIA regulations that are coming up. And I would put these regulations have been both positive and negative. Positive from the point of view that they are trying to increase the transparency of some of these products. They are trying to enhance the disclosure requirements that are there and ensuring that investors are getting what they actually thought they were buying into. So for example, earlier you used to have a problem that you would invest in a large cap mutual fund. You would find that the fund largely owns mid caps. Now it's difficult to happen for that. Similarly, even PMSs now have to kind of adhere to that, wherein there's a defined strategy that it needs to work with. So there's been a lot of positives that have been in this regulations. Clearly, the regulations are coming with a focus on how do we protect the investor.
Sure.
The problem that has been is some of the pieces of the regulations are also having second order impacts which are probably not great. For example, one of the changes that has been happening is, for example, increasing the net worth requirement. So that has already happened for the PMSs. It's proposed to happen for the RIAs as well. So it seems that the regulator believes that if we reduce the number of players in the market, that would ensure that people are getting better products.
Sure.
So I'm not sure of that. My belief is that over the longer term, having more and more players offering their services is a better deal for investors. I would still focus more on how to ensure that the other pieces, in terms of whether the returns that are being reported are transparent or not, whether they're accurate or not.
Sure.
Those kind of things are taken care of. People cannot mislead anyone through their marketing materials. Those are in better protection of the investors than preventing fund managers from starting off just because they don't have enough net worth.
Understood. Samit, would you like to add anything on the regulations part?
Yeah, it's when you launch a product, whether you decide to launch it through a PMS structure or an AI structure, the time horizon that you consider is longer term, because you are a longer term investor, so you'll consider 5 years or 10 years kind of an horizon. Unfortunately, from the time when you raise the funds throughout the journey of that, there are so many changes in the regulation that we need stability. There are tax changes. Like, for example, what Amit alluded to is, last year they came out with that surcharge, which was applicable to the trust structure, which is, the AIF structure. And suddenly, with almost the same taxation as a mutual fund, it changed to 40% tax.
Sure.
So with those kind of sudden changes, it just the risk for the investor just goes up, and they want to stay away from such structure. So you are launching so many of these different licenses, to increase the ease of investment, increase the options for investors to come into these structures. But then the different regulator entities, whether it's a SEBI or whether it's the IT department, they don't work together. There is no coordination, which is important, for investors to feel much more comfortable with those structures.
Absolutely. And I think one of the things that we are seeing from our side as well is that there's a emergence. While PMSs are obviously managed accounts, there are a lot of managed accounts which are sort of unregulated, and that actually increases from our side the risk on the system, saying that things can go wrong because there's no limits, there is no net worth criteria, etc. Tomorrow anyone can open and run some sort of a managed account. One of the other things that we've also always been toying is that, the perception of mutual funds versus the entire sort of the alternate products which are there right now, still needs to be educated, still needs to be informed. And how will that change? Because India at the end of the day is still a good amount of a push market rather than a pull market.
Right. So I think, from an investor perspective, you have a perception that mutual fund is a much safer product. In reality, obviously, it's the same portfolio. You'll invest in the same stocks. It's just that there's a different structure. There's a lot of regulation. There is tax incentive, which definitely differentiates mutual fund from that perspective. But suddenly, then they change the incentive structure for the distributors, right? So suddenly, then you have a whole world of wealth manager move towards the more commission-giving kind of structure, which is the AIF and the PMS. And with larger commission comes mis-selling.
Sure.
And that's the problem with the AIF as well as the PMS. Today the disclosure norm for a PMS is that you submit a monthly report on the SEBI portal, and which is at a consolidated level, right? So I may have 10 different schemes, but I'm submitting a report which is the combination of all the 10. Whereas a mutual fund, you get to see a daily NAV.
Right.
So those kind of disclosure norms, SEBI has to come in and increase the transparency in the products, as well as more control. As Amit was saying, is that when the distributors are selling the products, the mis-selling has to be stopped, because when there is no transparency, the way you present the performance, the way you present the risk involved in the portfolio, the risk involved in the strategy, the time horizon, it can be completely misrepresented, and especially when there is a huge upfront commission, which is offered by a lot of PMSs and AIFs.
Absolutely. Amit would like to hear your views on the same.
Yeah, no, so I think this is a problem that SEBI is trying to address, and this is a thing I'm actually happy about, that they are actually going after this. So in the recent PMS regulations, they have come out with a lot of changes which tries to address this. They have tried to come up with, for example, in the reports to investors, you have to disclose what are the commissions that have been paid to distributors. This had already happened with mutual funds long back. This is now also happening with PMSs. I think it will also happen eventually to the AIFs as well. There's also now, the regulations say that the returns that you're reporting in your marketing materials have to be the same returns that you're reporting in your disclosure document. So you can't cherry pick methodologies of how you're showing good numbers at one place and bad numbers at another place by just tweaking some things. So those changes are happening. I think as more and more AUM start flowing towards PMSs and AIF, this is not the, I would say this is not the end of the regulatory intervention that is happening from SEBI.
Absolutely.
This industry will get more and more regulated over a period of time. Yes, the PMS industry and AIF industry is still quite niche, especially when you compare to the mutual fund industry. But as it keeps gaining size, we will see far more stringent regulations. And I think we have to just be prepared for that.
Okay, fair enough. One of the things that we've seen has been missing from the alternate space is platforms which can sort of evaluate multiple products and at least have some sort of air of independence and evaluate all products. I think in the recent year and a half, we've seen this happen for PMSs and AIFs through various platforms. Would love to hear, your views on, how much is that sort of infringing on IP? Is it a good thing for the investor who is sort of, trying to evaluate a 2.2 or a SageOne? And how much information at the end of the day is good enough to make some sort of a decision to enter into a particular product?
Yeah. No, I think any more and more transparency, better information being available to investors is definitely better for the investors, irrespective of whether the fund manager likes it or not. Fund managers, if they would have their preference, they would only like to report returns when the returns are good. They would like to hide the returns when it's not doing that well. These kind of platforms are essentially ensuring that there is better availability of information to investors. And over the last couple of years, we have seen many of these emerge, be it PMS Cart that you have started, or PMS Bazaar, or PMSAIF.com. So there is better collation of information that's happening. The challenge still is that, we are still in the early days of that transparency push that is happening on the PMS and AIF fronts. Even now, the challenge is that two PMS managers are calculating returns in completely different ways. Even under the new regulations, there is no commonality of how the returns get calculated. It says that it has to be calculated for the time-weighted return, but it doesn't define exactly how that is done, kind of. So everyone can still take their own approach. So there is still challenges that are there, which would make even the job of these platforms still not that easy. So if you're hoping that there would be a value research of PMS or AIF that will emerge, it's still some time away. But nevertheless, investors have far more information today than they had 3 years back or 5 years back when these platforms didn't exist. You were just reliant on individual PMSs and how they were pitching it to you.
Correct. Sure. Yeah. Samit, would you?
No, it's a nascent start, and I think the problem is about conflict, because first of all, you need for such platforms, who is paying for that platform? How do you make money out of it, right?
Absolutely.
So if it's the PMS fund managers who are paying for it, or then there is a conflict.
Of course.
So there will be question marks on the credibility of the numbers. And again, if SEBI is only forcing you to report a consolidated number,
Absolutely.
for all the schemes put together. How do we reconcile? So
Sure.
that's going to be a question mark. So irrespective of whether it's an independent platform or not. So until I think this model, stabilizes, matures,
Sure.
there will be such question mark. But at least we are on that path. There will be some tweaking which needs to be done.
Oh, absolutely.
Yeah, which will happen, I think, over a period of
Absolutely.
time. Yes.
Great, great. Amit, to you, one of the themes that most investors have missed out on and is starting to look like an alternate sort of asset in India is global equities, right? They've obviously done well. They act as a sort of a natural rupee hedge as well, when investing in US. Any thoughts on whether this can become mainstream? I know a couple of mutual funds were trying to sort of bundle US funds into a mutual fund structure and sort of, give that option to clients. And also, how does the sort of the LRS angle play into for most investors?
Yeah. No, I think this would definitely be one of the alternative strategies which more and more Indian investors will start looking at. So far, investing in India has primarily been Indian equities or Indian debt funds. There has been very little exposure to foreign investments that has happened. And now the fact that on a day-to-day basis, now we largely interact with companies which are not Indian. For example, 90% of the audience here would be using a phone which has not been manufactured in India or is not an Indian product. We are using apps which are not been built by Indian companies, be it a WhatsApp, be it a Facebook or anything of that sort. We are increasingly using products which are being made outside India. So to still continue to focus on investing in only Indian companies, there is no good rationale for that. The challenge is how do you go about doing that? There are several limitations that are there. The LRS being the primary, it only allows you to invest $250,000
Right.
a year into foreign investments, be it equities or any other asset class. So clearly there are a lot of restrictions, but even in our conversations, we are seeing that, a lot more people are looking to invest. People are talking about whether we should be investing in a Google because our ability to understand Google is no less than a fund manager sitting out of, the US. Our ability to understand a WhatsApp or a Facebook, because WhatsApp, the largest number of users are in India. Facebook has one of the largest number of users in India. We understand these products very well. So we can very well be investing in these companies sitting out of India as well.
Sure.
So there will be more and more fund managers who will end up launching, funds, products, targeting the international markets. The US is obviously the thing that everyone is going after. We have funds like PPFAS, which have been trying to bring the international exposure through a fund.
And done well.
And done phenomenally well. The challenge being that they can only go up to 35% if they want to have that tax benefit of long LTCG. So there are still some limitations, but we are clearly seeing more and more people tackling it. So the first push is going to be just, investing in the US, developed markets. But a few years down the line, there's nothing that's going to stop from someone from India investing in a Bangladeshi company or a Sri Lankan company, because, we understand these markets quite well as well.
Sure.
We travel to Sri Lanka, we often travel to Dhaka as well. These are very similar markets to India, similar consumption patterns. We understand these markets. We would like to deploy capital there as well.
Right.
So these are still frontier markets. These would be considered exotic territories as of now.
Sure.
But from an alternative angle, I think next 5 years, 10 years, these categories will start seeing a lot of interest from investors.
Okay.
They will not just be satisfied investing in only Indian companies, and it does not really make sense even from a long-term perspective when a large part of the economy is now being driven by companies which are listed in outside, not in Indian markets.
Sure. Samit, would you have any views on global equities and, how to play from, let's say, your investors and your clients?
Yeah, I mean, I think there are a couple of benefits for global or the Indian investors. One is diversification, out of India.
Absolutely.
Because,
Sure.
almost their entire investment exposure is to India. So one is that advantage. And second is, as more and more companies are getting expensive in India, especially the ones which are consumer-oriented. And when you look at the performance of the global markets, especially when you compare US markets having done so well in the last 10 years, when India was supposed to be the growth story, and that was the reason, there was perception that India should outperform most of the markets. And when
Right.
you see such outperformance of the developed market, obviously you think of diversifying.
Sure.
And in India, there is so much concentration of flow into select few consumer B2C kind of businesses, where many a times these companies trade at 2x or 3x the valuation that you get in similar growth-oriented countries. It's an absolute diversification where you are getting much cheaper stocks, you're getting good diversification.
Sometimes we find it very difficult to explain to someone, why someone should be investing in a Nestle in India and not in Nestle in Switzerland, which is trading at substantially, lower valuations and benefits from the fact that it owns the majority in Nestle and also gets a royalty from that. Sure. And these companies don't have a limitation of just being limited to one market. A Nestle in India can only cater to the Indian market pretty much.
Right.
But these the parents will have ability to go into a lot many other markets. So it seems almost like a no-brainer why we should be encouraging people to invest outside India as well.
Right. No, I think that's one of the themes, and that's been, at least global equities has been one of the biggest misses for a lot of investors in the last 2 or 3 years. While we're talking about different investment themes, where do you guys see technology playing a part in terms of making it more efficient? I was just talking to someone from CAMS, and they said they're working on something to make PMSs or registering or subscribing to PMSs online. Right? Those are extreme challenges right now. Where do you see it going? Do you all see that are there enough players working on it to improve this aspect of innovation in sort of the alternate space?
Yes, so at least the way I think is technology is going to have the same role or same disruptive impact that it has had in other industries, even in the investing world as well. So for example, look at investing advice. The quality of investing advice largely depends upon the kind of capital that you're managing. If you have a larger AUM, you'll get the best of fund managers, reporting to you, giving you advice, best of wealth managers telling you exactly right products, what you should invest in. Technology has the ability to ensure that even a small investor gets fairly good advice. It might not still be one percentile or top decile, but it would still be quite reasonable. Similarly, technology has a big role to play in ensuring that geographical barriers no longer exist. So right now, for example, the advisory industry is often limited to just the geography that they operate in. For example, one of the majority of our clients would exist in Mumbai. If someone is based out of Pune, a large number of their clients would be based out of Pune. Someone is based out of Delhi, a large number of their clients would be based out of Delhi. It really doesn't make sense to think of investing from that. Or, if someone is sitting out of Kolhapur, he should be looking to invest in the best fund out there, not for the best fund in Kolhapur as such. So technology has the ability to even ensure that these kind of artificial barriers, which as of now do exist, come down. The ease of usage, that is absolutely a given that's going to happen. Even earlier, investing even in a mutual fund used to be a pretty tedious affair. Sure. And now you can buy a mutual fund at the press of a button. There are apps like Paytm Money, and there are hundreds of other direct platforms that are there which allow you to buy those. PMSs and AIF are still quite complicated. You have to sign 50 pages of forms. Eventually, that will also become at the press of a button. So technology will have the same, disruptive role of reducing costs, increasing ease, and allowing even the smaller guys to benefit from fairly good systems and processes.
Got it. Samit?
Right. So I think the kind of things we discussed before, is that once the transparency in the information increases, it's much easier for the investors to compare, and then do it without anyone's help. So I think over a period of time that will definitely ease. Second is the ticket size. The ticket size for a PMS is 50 lakhs now, and for an AIF it's 1 crore. And so for such a large ticket size, an investor would think 10 times before putting such a large money just based on a technology platform. But as this industry matures and they get more confidence with the managers, I think that should happen. But I think we, especially for the PMS and AI, just because of the ticket size, I think we are pretty far away from that.
Okay, okay, fair enough. And one sort of part of the ecosystem that we've not touched on is sort of the advisor and the distributor community. Obviously, there's as you earlier mentioned, there's conflict of interest, who's giving what commission, etc. But from my standpoint or from an advisor standpoint, do you think we also will need to upskill fairly quickly to keep pace with, the fancy things that you guys are doing in terms of innovation? Today, obviously, we have PMS and AIF. And I know a lot of people are still not sort of become in tune to these products or, want to sell these products or market them or advise on these products for the simple reason that they don't want to upskill and don't want to innovate while the world, from your standpoint, is moving forward.
Right. Yeah, see, my experience has been, it's very difficult to get a really neutral advisor.
Sure.
Most of the advice is dependent on, one is the commission and what's easy to sell, right? So if large cap, high quality, consumer oriented, stocks have done well in the last 2 years, it's the easiest product to sell. Whereas an advisor who is experienced in the market would know that each investment style, investment strategy is cyclical. Something which has done well in the past, not necessarily will do well in the future. And sometimes it's better to get the investors in strategies which has underperformed, but in the long run, the return profile is pretty high. But that very, very rarely happens. So I think it's more to do with the incentive and ease of selling rather than understanding of the product. I think that.
Well, if I could ask you, what is one solution to this? Or is it just the way the markets are, even in developed countries, sort of, are we moving towards an advisory model where conflict of interest sort of reduces significantly?
Yeah. I think solution is, is going to be, the incentive should be longer term oriented. It should not be upfronted. But unfortunately, there is very little regulation that, now at least the new PMS regulation as well as the investment advisory regulation, which is against upfronting of commission. So I think that's a great solution that, the regulator has come out with. But the alignment of the advisor remuneration, the fund manager remuneration, and the investor remuneration has to be aligned. Once that happens, I think a lot of those other aspects should not be that critical.
Okay, fair enough. Amit?
Yeah, no, I think the conflict of interest will only be brought down if you also bring in the skin in the game for the advisor or the distributor as well. So, over time, I think more and more people will start demanding that, you're recommending this product, but where is your money invested? Right. Just like, we had fund managers, mutual fund managers being required to disclose their investments into the fund. I think that will become a very standard expectation that if you are marketing or distributing a product, you better have, a certain skin in the game. Of course, there are always question marks that, your appetite might be very different, your goals might be very different. So is that really right for the client to expect that, the distributor would also have to invest in such products? So there will be some way a middle ground, but that conflict of interest is something that will be raised every now and then, with now investors becoming aware of the commissions that are being charged. And I think in some cases, they'll really get the shock of their lives when they see the kind of commissions that are being charged in some of the products that are being sold. Sure. And when they see that kind of commissions, they might start thinking that maybe it was not really, neutral advice that they were getting. Maybe there was a lot of incentive for the distributor to actually sell me that product, even if it was not the right product for me. So that transparency is going to take its place. I think the other changes that again is going to happen because of technology, and that's applicable both to fund managers and to distributors or advisors, is that earlier you could just get by helping on say execution or paperwork and those kind of very basic stuff. So even if you had no skill set in terms of identifying a good fund manager or identifying a good product, purely because you are willing to do the grunt work, you could still build a reasonable, AUM, because you were helping in execution, you were helping in a lot of other stuff. Technology is taking away a lot of that. So now advisors will have to become pure play advisors. They'll have to be real advisors. They will have to play a bigger role in terms of helping the clients understand the risks that are there and whether the returns are adequate or not. They will have to play a bigger role in helping them, navigate the ups and downs of both the equity and the debt markets. So I think technology will force both, a more real role for all these players that are involved. A fund manager will have to be a real fund manager. Advisor will have to be a real advisor.
Sure. So just to wrap things up, and I might be putting you all in a box out here, but generally people tell me one theme to sort of buy into or a stock to buy into. I'm going to ask you an alternate question. Which stock should I not buy into and which theme should I not get into? Right, what are you guys looking at?
I would say the theme where you have the highest confidence or where you feel the most comfortable in at this point in time, because a lot of people are advising you to do that, it's something that you should stay away from.
I'm going to still push you for an answer, Samit. Can be a range, can be a broad, can be a theme?
No, I'm not that bullish on the consumer-oriented theme.
Okay.
Because India, I feel, has a lot of employment-related issues.
Sure.
And consumers are going to take that hit. There are a lot of issues with jobs. The highest job-generating industries, which is real estate, textile, auto, are going through a huge disruption, transition,
Sure.
struggle, balance sheet stress. Who are going to replace those jobs?
Right.
And there is such a big population explosion that we are having, will definitely hit the consumer side.
Okay.
And given the valuation at which these consumer-oriented stocks are trading at 80, 90, 100 times,
Right.
it just doesn't make sense for me.
Fair enough. Thanks, Amit. Sure. Amit?
Yeah, so I will obviously not be taking any name, but again,
okay.
from a broad category, I would agree with Samit. Some of these, I think there has been over the last few years this prevalence of quality at any price
Sure.
can be bought, and if you have done that, you would have done fairly well from a returns point of view. I think a good idea has been stretched too long now, and I wouldn't go after that strategy incrementally. I was saying this probably 1 year, 2 years back as well. So
Okay.
it's probably a case of a broken clock eventually being right at some point.
Sure.
But I think justifying some of the justifications that are being given to invest in these companies are not fundamentally based. They are more emotional, and that people will always pay premium for this. Of course, people will pay a premium for good businesses, but is that premium a 40 times P, whether it's a 50 times P, 80 times P? At some point of time, you'll have to sit back and say that this really does not make sense, and probably some of these stocks are in bubble territory.
Okay.
So if one category I would put that consumer B2C high quality names, which are trading at 70 plus P multiples, and assuming that nothing can go wrong with them going forward.
Okay.
That would be an area that I would avoid.
Fair enough. Fantastic. Let me thank you, Amit and Samit, for a great discussion. Thank Aditya for setting this up. We were there, right? For setting this up, and your entire team to make it into a really smooth sort of event. And I think we're good. Thank you.
Thank you, Aditya.
While listening to you guys, I was just regretting we should have had it earlier so that more people